Good afternoon. Can you hear me? Today is week 6 of the $50,000 challenge. We will be looking at the results of last week, the week before, the other previous weeks, and we will be making it better. I've been having some audio issues, so I didn't upload last week's live broadcast because there's no audio, and I didn't really have time to re-record it. So we're going to be working on that. We're also going to be hopefully adjusting the mics so that the breathing noises aren't in the way. So let's check the audio now and see how it goes. We're going to be working on that. We're also going to be hopefully adjusting the mics so that the breathing noises aren't in the way. So let's check the audio now and see how it goes. All right, hopefully this is working. Cool beans. Yeah, so let's start with some. Let's talk about. Actually, let's read the thing. So remember, Perfactor is this algorithm that I invented. It's run in Python. It's mildly threaded. It does everything. Basically, the goal is to have a long-term investment algorithm that you buy something, hold it for 6 months to a year, and then hopefully beat the S&P 500. Here's a disclaimer. Nothing contained within this program should be considered a stock recommendation. The purpose of this program is to analyze the effectiveness of a proprietary investment algorithm, not to recommend any stocks or purchase. Investors should be cautious about any and all information provided during this program and should consider the source of any advice on stock selection. Various factors may influence or factor into a stock analysis or opinion. All investors are advised to conduct their own independent research into individual stocks before making a purchase decision. In addition, investors are advised that past stock performance is not indicative of future price action. You should be aware of all the risks involved in stock investing and to use the material contained herein at your own risk. No guarantee is made about the accuracy or validity of any information presented during this program, and no responsibility will be taken for any errors or omissions which may have occurred. The analysts, ratings, and/or other information presented during this program do not provide, imply, or otherwise constitute a guarantee of performance. Don't buy anything that I talk about. Don't do it. Don't do it. It's a mistake, as you will soon see. So actually, it's not a mistake. We're picking a lot of really good winners, and then some losers. So they're losers. What can I say?
He's a loser.
I get a kick out of that. So today what we're gonna do first is we're gonna look at the last couple weeks performance. Again, we're on week 6, so we've already purchased 5 weeks. We're about halfway done. Is it up? Okay. So let's scroll up to the top. Yellow. We sold a bunch of stocks last week because we after losing a bunch, we instituted a minimal loss stop loss plan. And we'll talk about that once we get to look into it. So week 1, which was 5 weeks ago, we are currently at we're slightly behind the market. We're at 2.03%, while the market is at 2.67%, which isn't terrible, but it's not really good either. We did pick one amazing winner. At LUK is up 13 some percent. Which is pretty good. Let's see here. Week 2, market's at 2.46%, and then we are down 0.47%, specifically because of one stock, NAVI, which is the reason that we instituted the stop loss plan last week. It dropped 10% in one day about 2 weeks ago, and then basically, because I didn't have a sell plan or a stop loss plan, it continued to go down. And because I didn't have a plan, the losses kept getting bigger and bigger and bigger until finally we're like, we got a stop loss. So because of NAVI, we have instituted a new plan where if a stock drops 8%, we sell it. I wasn't paying attention today, so we might have some stocks slightly below 8% that I haven't sold yet, but we'll look into that for selling them. So lesson learned. It cost me $181, but it was worth it to learn that lesson. Expensive lesson. Week 3, same thing. Looks like, yeah, we're not doing good here at all. 2.2% is the market, and we are down 5%. You'll notice that week 3 was the second week we had the PE ratio with this adjusted rates. AGN was down 8%. FL is down 11%. Again, these two we didn't have the plan in place before they did anything. So highlighted in yellow means that we're selling it, have sold it, and then it looks like I need to sell AGN tomorrow. I think I was going to sell AGN last week, but um, when I logged in to sell it, it was actually up. So I was like, well, it was up above the threshold that we had set. So that's all right. Week 4, we were also down 4%, which is terrible. We've lost every single thing. Again, we sold FL. Footlogger sucks. And because of AGN. So yeah, I'll sell that one again. And then last week, we are up. What did we change last week? So we added the PEG ratio, which is the price over earnings growth. I forget exactly what it stands for, but it's essentially a growth potential basic fundamental analysis of the stock. And one of the things that we noticed last week is once we added it, basically FL was no longer even an option. It went from being like in the top 3 or 4 of the stocks recommended to being in like the bottom half. And that's because its PEG ratio was so terrible. Let's pull it up actually. Let's look at it. So let's look at FL, which is what we're talking about. Specific, we're going to look how Perfactor changed the rating of it. So last week we added the PEG ratio, and it went from the supposedly 5th best value according to this algorithm to the 46th best value because its PE ratio. I'm sorry, it's oh, did I not update this screen to include the PEG ratio? Interesting. So anyways, its PEG ratio is negative, which is really, really bad. And it's really high negative. It's negative 71. So it's like terrible. It's a terrible PEG ratio. So once we added that, we're no longer looking at stocks with bad PEG ratios, basically. And then it changed like this. It went from 5th to 46. So we've improved the algorithm. So again, this is why I don't buy anything that I'm talking about, because I don't know if this algorithm's any good. We're trying to make it better. So that's what we're trying to do. So stocks like FL are no longer going to be recommended, hopefully, that have bad, or they won't be recommended if they have bad PEG ratios. Let's go back to the thing. So week 5, that was week 5. We were beating the market a little bit better again, so that's good. So let's. So yeah, we're looking at some improvements here, which is good. So that's pretty much where we're at. PEG ratio is getting better, made it better. And then this week what we've done is we've looked at what we added is what I'm calling the trend score. So for those who don't know, basically there's 2 types of, this is very general, so this is not 100% accurate, but there's a couple different ways to analyze a stock to depend on if you think it's going to make you money in the long term or short term. So there's something called value investing, which basically looks at the fundamentals of the stock. Are they making a lot of money? Do they have a good PE ratio? Is their management good? Do you believe in the business model of the company? And that kind of thing, that kind of theory is like Warren Buffett, Benjamin Graham. That's one mental model of evaluating a stock. Another mental model of evaluating a stock is something called trend analysis. And it's quite complicated, but basically it's, all right, is the stock going up? Okay, then it's probably going to continue to go up. Is the stock going down? Okay, then it's probably going to continue going down. This is something I've been learning and researching over the last 2.5 weeks, I think, but I finally got to the point where I feel like I understand it at least enough to implement it in this algorithm. Before I get too crazy here, let's talk about some basic terms. So there is something called a simple moving average. What the simple moving average is you take a stock and you take the closing price of, well, one way to calculate it, the one that I'm looking at, is a daily closing price of the stock. And then, so you look at the simple moving average, so it's the average closing price of the stock over the last X number of days. So for example, the simple moving average for a 5-day period for a stock would be you take the last 5 days closing price and you just average them. It's a simple average. And it's called a moving average because every day it moves because it's only 5, so it's only 5 days of history. You can do it for longer. You can do it for 20 days, 100 days, 200 days. Really, you could do it for its entire lifetime, but it's kind of a ridiculous thing to do. So we didn't really do that. So the theory behind trend analysis, or one of the ways of looking at trend analysis, is if a shorter time period simple moving average is higher than a longer time period simple moving average, the stock is trending up. So what does that mean? So let's say that over the last 5 days, the simple moving average is, I don't know, let's say $100. And then over the last 200 days, the simple moving average is, let's say, $75. According to the theory, because the shorter time period simple moving average is higher than the longer time period, the stock is trending upwards. So it's over time getting higher and higher and higher. That's the theory. Does it work? Well, according to the theory, yes. So I didn't come up with this. This is something else. I read about it on the internet. You can check out more about just Google or Bing or whatever simple moving average stock trend analysis. You'll find a whole bunch of articles. So what I did this last week is in this right column here, you can see it. It's called the trend score. Let's just look at all of them for October 19th. Basically, I'm looking at the 5-day simple moving average, the 10-day simple moving average, the 20-day simple moving average, the 50-day simple moving average, the 100-day simple moving average, and then the 200-day simple moving average. Why am I looking at so many? Because there aren't standard ones to look at. Some sources recommended comparing the 50-day to the 200-day to determine if it's trending. Some sources recommend comparing the 5-day to the 10-day to see if it's trending. Some people compare the 25 to the. So basically, it's there's not a consensus on which ones are the most important. So I'm looking at all of them. And if you can, out of those 5 time periods, if you compare the shorter one to the longer one, there's 15 total comparisons. So what I've done is come up with the trend analysis score, which is here on the right. So basically it's a score from 0 to 15. If every single shorter period is higher than every single longer time period, it gets a perfect 15 on the trending upwards scale. And then if every single shorter simple moving average time period is lower than every single longer time period simple moving average, it gets a 0 on the trending score, which means it's trending downwards. The price is going down. Does that make sense? I'm hoping that makes sense. So yeah, that's basically how I came up with this trend score. If you look at it, if you see it here on the right here in the score, 0 on the left is the score from 0 to 15, and then the 0.0 is how many points I'm assigning it towards the algorithm of Perfactor itself, so how much it's weighted. So as you can see here, these are the worst ones. They're all trending downwards supposedly, and so they're not getting any points in the simple moving average. If we reverse this, we've got stocks like MHK, MAT, where 14 out of 15 of the simple moving average trends that I'm comparing, time periods, 14 out of 15 indicate that it's trending upwards. So again, the theory is the more upwards trending indicators, the more likely it will continue to trend upwards in the future. Is it guaranteed? Absolutely not. Absolutely not. So basically, this is the first week that I've added this to the algorithm, so I don't know if it's accurate, if I'm weighting it properly or anything. I just kind of made something up and put it in there. So for a 14 out of 15, it's getting 5.6 points compared to it's only getting 6.3 points compared to the Perfactor buy-sell rating here. So it's kind of arbitrary, or it's kind of not. Another change this week that I made is I adjusted the PE ratio points assigned because some of the lower PE ratios were getting like 12, 13 points, and that's just ridiculous considering how getting 12 points from the PE ratio alone threw off the balance. It basically was out of balance. So I balanced it, I nerfed the PE ratio score a little bit. So that's where we're at. It's pretty exciting. We'll see how it goes. So what I want to do, here's the rankings that we'll see. You'll notice that there's still a couple at the top Macy's, M particularly, which is getting a zero trend score. And we'll talk about why in just a second. But before we get into that, let's look at what I mean by trending. So I just opened up the 1 year chart, if it loads, of Macy's in Yahoo Finance. Again, I can't recommend Yahoo Finance enough. I really like all the information that they have for analysis, so it's pretty good. So what we're doing is we're looking here at the 1 year chart. Way back about a year ago, as you can tell, the chart is kind of trending downwards. What do I mean by trending downwards? The average slope of the line is down. The price has dropped from $44 to $20. It's less than half of what it was a year at its high in the last 52 weeks. Downtrending. So, according to the trend theory, which may or may not be accurate, Macy's is likely to go down in the future. Right. Let's look at the next stock, MHK, and its trending score. 14, almost perfect. It's only missing one out of all of them. Alright, let's load the chart here. Completely different shape of this in the last year. As you can tell, it's at almost a 52-week high of 261 compared to a year ago where it was roughly 190. And it was within the last 52 weeks, within the last year, its low was 176. So again, the theory here is it's a long-term trend, so the trend is likely to continue. So we're weighting that in the algorithm, which kind of mix it up a little bit, which I'm kind of interested in. So yeah, what can I say about that? So yeah, we added in that. I'm not sure if that's good. So those are the two adjusted things that I did for the algorithm this week. And again, we're going to choose 5 of the top however many stocks, and then I'm going to be purchasing $1,000 roughly of each one tomorrow, roughly around 9:30 Central Time, whenever I wake up and get around to it. Same as every other week. So let's look at Macy's, because this is the it's the #1 rated stock. Now we just saw that it's trending down long term and has 0 trend indicators. So why is it ranked so high? The PEG ratio is extremely good at 0.32. The price over earnings ratio is, I mean, anything less than 10 is good. So it gets 5.5%. It's got a solid dividend of almost 7%, and it's got an estimated return of 25%. So that is why it is so highly rated by the algorithm. Am I going to buy it? Absolutely not. Am I going to buy it tomorrow? Absolutely not. 0 trending. It's Macy's. My personal opinion is that brick and mortar stores will continue to reduce sales over the next couple years until they're consolidated and replaced. So Macy's is not going to be one of them for tomorrow. MHK, which is the Mohawk, I believe it's Mohawk Flooring or something. They do floors and that kind of thing. They are at a solid, actually a not very good PEG ratio. So anything less than 1 is undervalued by the market, and everything over 1 is supposedly overvalued by the market. But their not good PEG ratio seems to be balanced out by their great PE ratio. 5.23 I think is the lowest. Let's see. Yeah, it's the lowest in the entire S&P 500 that I'm looking at. So that is a solid PE ratio. Where'd it go? No dividend. Estimated return is 5%, 6%, which is not great. That just means that it's almost at the top of the analysts. Basically, I don't know. I mean, 5% still pretty good. It's got a very good buy rating. Remember, -1 is sell, 0 is hold, and then 1.0 is buy. So 0.6 is a very solid buy signal. And then it's trending upwards. It's got almost 100% trend score, so that's quite good. So 5.93% is okay. Am I going to put it on the list? I'm going to put it as a maybe, because if you're holding it for 6 months to a year, you kind of want to make more than 6%. And without that dividend, it's not really all that all that good in my opinion. All right, number 3, AMAT. I do not know what AMAT is. AMAT. Applied Materials. Oh, I bought some of this last week. This is the they do like basic what is it called? Like steel and oh no, semiconductors, equipment and materials. So they build electronics, basic electronics. PEG ratio, very good, 0.6. They are undervalued by the market. PE ratio, PEG ratio is 0.6. PE ratio is 19, which is not terrible, but it's really not good either. Dividend is, well, they pay a dividend. That's about all you can say about that. Price targets, estimated returns only 5%, not really all that good. The per factor rating is a very, very strong 7.7. And then the trending is very good at 14. Let's look at their chart here. Yep, they've been going up, 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 up. So the question is are they at the top? Well, according to the analysts, they've only got about 5% more to go, and then it will be down. That will be supposedly the peak, but again, who knows if that's accurate or not. So I like them quite a bit more. Well, I like them about the same as MHK, so I'll again have them as sort of a maybe on the list if there's no other good ones. Let's look at AGN. Not trending at all. So another reason I wanted to put the trending information in here is because if a stock drops a lot, if the market doesn't think it's very valuable, if for whatever reason, the PE ratio is going to be really good, right? If they make a lot, if they have good earnings, but then the price is low, it's a ratio of price over earnings. So if they could, right? So basically, a low PE ratio means it's highly valued, but that doesn't mean that it's a good stock. It just means that the numbers or whatever, or it doesn't mean Mr. Market thinks that it's any good. So anyways, Allergen, yeah, whereas is not trending at all. It's probably going to go down. It's probably going to continue to go down, which is why because the prices dropped so suddenly, all of these other things haven't had a chance to catch up. So is the return percentage really 40%, or is that just like they haven't changed their estimate yet? The analysts haven't changed their estimates yet because it's been such a short time period. I don't know. Either way, AGN is not on the list. I'm not going to buy it. It is no longer an option at all. WDC, Western Digital. They make some of the best hard drives available. They have 3 out of 15 trending, so it's kind of trending. I don't have the visualization yet, although I do have the data. I just have to look into it about if it's short-term trending or long-term trending. Usually if it's the lower number, though, it tends to be a short-term trend, so who knows if it's stationary. PEG ratio is great at 0.26. That is a wonderful PEG ratio. PE ratio is not good at all. 63 that's just, I mean, it's not Amazon bad, but it's not really bad either. Or it's not good. Dividend percent, 2%. That's a pretty good one. An estimated 32% potential return is very solid, and then a 0.6 essentially buy rating is also very, very solid. So out of all of that, the only one that I don't really like is the PE ratio. What can I say? I don't like it. Let's look at the year-long chart to see if we can tell if it's the trend, because it's only got the 3 out of 15 indicators. So I'm going to bet that if you can see my mouse here, it looks like this was a pretty, and obviously I'm not an expert in this, and this is only based on examples that I've seen over the past week, so 2 weeks. So pretty much ignore everything I'm doing here. This is trending this period up through, what is that, mid-July? And then whatever this peak is, I would bet that now it's in more of a, that looks like a more of a downtrend. So I'm not so excited about Western Digital. Actually, I am kind of excited about it. Maybe, I guess it just kind of depends on what's trending or not. PWR. Very good PEG ratio. It's below 1. A decent, but not great PE ratio. 21. No dividend. 15% return potential. A very solid 6.7 buy rating. And a very solid 12 out of 15 trend indicator score. This is the first one where it's honestly very strong across the board, except for the dividend and then the average PE ratio. Let's look at the trend, or the chart. So it looks like it's been trending since at least June, mid-May, June. I like that. What is PWR? I don't even know the company. Power, probably. Quanta Services. Wonder what they do. WDC is consolidating. What does that mean? Are they purchasing? Are they selling off some of their side businesses? Quanta Services provides specialty contracting services to the electric power, oil, and gas industries in the United States. So they are an infrastructure company. So basically, as long as America requires power lines and gas pipelines and whatever else, they're going to have work. Okay, I'm putting PWR on the list. I like it. It's strong across the board. I can look past the no dividend for that. All right. Let's look at CVX, which I don't know what that is. PEG ratio 0.5, very good. PE ratio 40 is not good. Dividend of 4%, 3.5% is good. 1.7% estimated return, very low. Basically, it's peaked according to the analyst estimates. Very good a good 0.45 buy rating, and then 14 out of 15 trend indicators. Chevron. Oh, it's the oil company. It's pretty much a sine wave, it looks like. It's right around the 52-week high, which explains why I just feel like there's not a lot of upside potential on this. Just feeling it out, which is reflected by the estimated return percentage. I'm going to not put CVX on the list just because it's got nowhere to go. It's already at the top. All right, NFX. So looking at the 8th stock, and I've only got one picked out so far. The trend is consolidating, equal buyers and sellers. It's not trending up or down. Okay, so it's just kind of like and it's not really working. Basically, it hasn't decided if it's going to go up or down. Is how I understand that. Although I could be wrong. What are we looking at here? NFX 0.66 PEG ratio, very good. 19 PE ratio is average. 25% potential upside, 0 dividend. I don't really like that. Very good buy rating. 10 out of 15 trend indicators. That's good, right? NFX. Newfield Exploration Company. So it's missing 1/3 of the trend indicators. So that, to me, because I don't have the details right in front of me, I would guess based on this chart that the long-term trend indicators are not there yet. So I'm going to bet that the short-term simple moving averages are lower than the long-term simple moving averages. But it looks like the short-term simple moving averages are higher than the medium term. So that's why it's only getting 4 points out of a possible 6 there. So do I like it? NFX. I like the peg. PE's ratio is okay. Dividends is bland. Dividend is bland. Price target, estimated return is good. Buy rating is good. I like the 10 indicators. I'm going to put it on the list. NFX. Got it. LRCX. I have no idea what that is either. 0.79 peg is good. 21 PE ratios okay. It has a dividend at 1%. Price target is 4%, which makes me believe it's at the top of its thing. Very good buy rating. And then 14 out of 15 trend indicator score. Yes. Well, look at that. It's been going up all year pretty steadily. What is this company name? Lam Research Corporation. Will it continue to go up? I mean, probably, right? That's the trend theory. But it's only going to go up an additional 5%. Everything else is solid across the board. I think I'll take it. LCRX. See what they do exactly. Technology, semiconductor equipment and materials. Okay. They're based in San Jose, Silicon Valley. Semiconductor processing equipment used in the fabrications of integrated circuits. Okay, so they make the machines that Intel uses to build the chips. I'm going to bet. I don't know if that's true or not, but that's my understanding of what this is saying. All right. I like them. ANDV. It's rounding out our top 10, although we've only got 3 and, 6, depending on how you count it, potential buys here for me. ANDV. 0.65 peg ratio is very good. 40, roughly. PE ratio is bland, blah. 2.26% dividend is pretty solid. Potential 9% return. Very good buy rating. Trending 12 out of 15 indicators. Let's look at that chart. Andover. Another company, I have no idea what it is. Funny how that works. Here's the chart. It is long-term. It's definitely towards the highest of its 52 weeks. It's at a record high, 52-week high, like in the last week or so. Short, I would say medium term, it looks to be on the up. It's whatever happened around April or May here. It's hit a bottom and now it's going up again. So I don't see anything that blares out warning signals on this at all, except for the fact that it's very close to its 52-week high. Let's see what they do. They're based in Texas. Independent Petroleum Refining Logistics and Marketing Company in the United States. Huh. Okay, so it's a Texas oil company. Very nice. I'm gonna. Well, let's look at the numbers again. And again, everything I'm saying is not a recommendation. Don't buy any of these stocks. I'm using it to evaluate and improve the algorithm. ANDV. I like the peg. Basically, the only thing that I don't like here is the PE ratio, and I'm okay with that. I'm going to put it on the list. ANDV. So we've got 1, 2, 3, 4. 4 that I'm looking to buy here. All right. Let's look at LKQ, which is another company that I don't know what it is. 0.75 peg ratio, good. 23 PE ratio, average. 0 dividend. 7% potential upside, which is not very good. Very good 6.64 buy rating, and then 14 out of 15 trend indicators. All right, LKQ. LKQ Corporation. Oh, thanks. Let's look at this chart here. It looks like it bottomed out in April in the last 52 weeks. It is also setting 52-week highs here. Although, I mean, the whole market's up. The whole market is setting records. So, oh man, I don't know. I don't see anything. It looks to be pretty steady in the last 6 months. Pretty steady climb. Will that continue? I have no idea. They are based in Chicago. They do auto parts. Okay. Distributes replacement parts, components, and systems used in the repair and maintenance of vehicles. Bumper covers, automotive body panels, lights, and automotive glass products, windshields, such and such. Auto fluids, steering. Okay, so they provide, I'm going to bet that they supply parts to the manufacturers as well as to like repair shops and that kind of thing. Is there going to be a need for that in the foreseeable future? Yes. Even if cars get fully automated, I think that this is still going to be, probably, I don't know if it's going to be less or more, but there will still be needs for repair parts and new cars. So I'm not worried about the industry, if that makes sense. Do I like it enough to buy it? I don't know, let's look at one down, NUE, because just glancing at it, they look pretty similar except for slightly different. Same PEG ratio, a better PE ratio, a better dividend, because it actually has one, a better price target, a lower buy-sell rating, but it's still a good buy, and then less, there's only 10 trend indicators instead of the full 14. So let's look at it. Oh man, I'm not sure what to make of the shape of this stock. It looks like it was basically flat. It rocketed up from last October to, it hit its peak on January something, or in December. I'm sorry, last December. And then it slowly, well, it dropped, and then it was I would say this is basically flat with a slight downtrend. I don't like the shape. Obviously, I don't know what I'm doing because I've only been looking at trending data for the last 2.5 weeks. This is like new to me, so I haven't fully wrapped my mind around it yet, if that's even possible. But I like the shape of, I don't know, man. Should we do LKQ or NUE? I can't really tell which ones I like more. The potential return is, I mean, roughly the same, right? The dividend on NUE, does that compensate for the 14 trend indicator score? What to do? Also, the PE ratio is lower on NUE. You know what? T&H, NUE. I think NUE is a steel company. I think I'm going to go with NUE. I can rationalize it, but basically they look pretty much the same to me, except for NUE it just feels better. I feel like the lower PE ratio, the dividend, I mean, I'm just rationalizing here, the higher estimated return percentage, I think that those, because I understand those numbers better, what those mean, outweigh the trend indicator and then the buy rating. I mean, the buy rating is pretty arbitrary, right? So, yeah, we're going to do NUE. I'm going to add NUE for tomorrow. All right. Boo auto parts. All right, so we got 1, 2, 3, 4, 5. All right. So that rounds out the list of 5 stocks for tomorrow. Again, don't buy these at all. Don't do it. PWR, NFX, LCRX, I'm sorry, LRCX, right? Yep. ANDV, NUE. So those are the 5 that I will be purchasing tomorrow morning whenever I wake up. Alright, I believe that's pretty much everything that I'm going to cover. A little bit longer podcast today. Went for a good 40, probably 45 minutes by the end, but that's alright. We had some new information to analyze and to wrap our heads around. Again, Perfector is just an investment algorithm that I'm making. I'm not making stock recommendations. I'm evaluating the effectiveness of the algorithm so I can make it better over time. Check it out at perfactor.net. You can also, follow, just hit the follow button right now. And then if you're listening to the podcast on YouTube, you can check us out on twitch.tv/DIRJK. We do this live every Thursday at 3:30 p.m. Or if you're watching us on Twitch, you can catch the podcast on YouTube. It's available. There's links on our Twitter, which is twitter.com/DIRJK_show. All right, that's pretty much all I got today. Thanks for joining us, and we will talk to you next week. Yeah.